I want to work with you through the Chapter 5 worksheets. These are listed as optional problems on your work page, so on your course page. If you could, make sure that you have those, and we'll work through those together so I can help you with where the answers come from. Be aware that Chapter 5 historically has probably been the most difficult chapter of the textbook. So therefore, I want to give you all the resources that I possibly can to help you with the understanding of this chapter. So, dealing with this first worksheet on Chapter 5, we're going to calculate the gross domestic product, gross national product, net national product, national income, and disposable personal income. Now, we have two formulas that we use to find the gross domestic product: the income formula and the expenditures formula. If you look at the information that's given, you will see that there are income items, so therefore we're going to use the income formula to arrive at this. Now, the income formula is given as wages plus interest plus rents plus profits, and those profits are coming from sole proprietorship, partnership, and corporations. We're going to add back the capital consumption allowance. We're going to add back the indirect business taxes, and we're going to subtract out the net factor income from abroad. That will give us the gross domestic product. So with that in mind, we're going to plug the numbers in. So looking at the top, wages are given to you at $16.50. Interest is given to you at $35. Rents are given to you at $25. Profits are given to you at $100. Sole proprietorship profits. Capital consumption allowance is $10. Indirect business taxes are the same thing as sales taxes, same thing as indirect business taxes, IBT, 40. And our net factor income from abroad, we're going to take income that Americans earned abroad, which is from Exxon in Mexico, and we're going to net that with Japanese residents' income that was made at Whitewater Bay. So therefore, 50 is United States made abroad, and 30 were other countries made in the United States. So we net that to be 20. Once we do that, our gross domestic product will equal $1,840. $1,840. From that, we're going to find the gross national product. The gross national product will take our gross domestic product and add back the net factor income from abroad, and that will arrive at gross national product. Okay, gross domestic product was calculated at $18.40, and we're going to add back the net factor income from abroad that we calculated in the previous formula. Once that happens, we'll come out with $1,860. Next item we're going to calculate is the net national product. So we're going to take the gross national product and we're going to back out the capital consumption allowance, and that will give us what's called the net national product. The gross national product we calculated at $18.60. Capital consumption allowance is 10. So therefore, we're going to calculate net national product as $18.50. Our next item is going to be national income. So to find our national income, we're going to take our net national product and we're going to back out our indirect business taxes. Now these are sales and excise taxes, and that will give us national income. So we're going to take this $18.50. We're going to back out the indirect business taxes of $40, and that will give us $18.10. Next item is known as personal income. So with the personal income, we're going to take the national income. We're going to add back income received, not earned, and we're going to subtract out income earned, not received. And that will give us personal income. With that, let's start with our $18.10. Now, let's go back up at the top. At the top, all transfer payments are income received but not earned. All transfer payments are income received but not earned. And then if we look up, we have income earned, not received, and we also have Social Security taxes and Medicare taxes that are deducted from the workers' paychecks. So the workers have earned that, yet they have not received that to be able to spend. So we're going to add back the transfer payments, and we're going to subtract out the $170. So our personal income will end up being $16.55. $16.55. Now, to find our disposable personal income, we're going to take that $16.55 and back out our personal taxes. So if we go back up at the top, personal taxes are given to us at $520. So we have our disposable personal income spendable in the economy to equal $1135. So we've gone from $1840 of gross domestic product to disposable spendable income of $1135. All right, let's proceed on into the next page. Let's come on into the next page. The first one says, what is the value of this DVD player for gross domestic product? The components, the assembly, the wholesaler, and the retailer are all included, so we have $140 as the value of the player for gross domestic product. Now let's come on down, and it tells us find the following. Gross investment is equal to net investment plus capital consumption allowance. So to find our gross investment, we're going to take our net investment of $45 and add the capital consumption allowance of $75. So that will give us gross investment of $120. Gross investment. Now, net exports minus imports. So we go back up to the top. Exports are 76. Imports are 100. So we end up with a negative 24 as net exports. C, gross domestic product. When we look at what's given to us, it is the expenditure formula because we're given consumption spending, investment spending, government spending, net export spending. So we're going to use the formula consumption plus gross investment plus government spending plus net exports, because it is the expenditure formula. So in dealing with this, consumption is given to us at $560. We just calculated gross investment at 120. Government spending is given to us at 144. And we've just calculated a negative 24 for our net exports. So once we add those four components together, our gross domestic product is $800. $800 for gross domestic product. Now to find our gross national product, we're going to take our gross domestic product and add back in the net factory income from abroad to give us gross national product. Gross domestic is 800. Go back up to the top. Net factor income from abroad. We're going to take the payments of factor income and the receipts of factor income and net those two together. So we made 25 in receipts, 75, that's 30, and that's 30 in payments. So 25 minus 30, 25 minus 30 will give us a negative 5. So therefore we're going to end up with $795 for gross national product. Gross national product, negative 5. Letter E, what is the net national product? Formula is gross national product minus the capital consumption allowance for the net national product. We calculated out 795 for gross national product. We're given 75 for capital consumption allowance. So therefore, our net national product calculates to be $720. And the last one says, how much is national income? National income is our net national product minus our indirect business taxes. So therefore, once we look at those, that will give us national income. Start with 720. Go back up to the top. Indirect business taxes are given to us at 65. So we'll end up with national income of $655. So we did essentially the same formulas with the exception that we used the expenditure formula for gross domestic product, where in the first problem we used the income formula for gross domestic product. And then our gross national product, net national product, and national income formulas are very similar, exactly what we had with our previous problem. Okay, let's go down and turn, and let's come down to the next page. So let's come down to the next page. And the next page says, classify these as consumption, government, investment, or net exports. So if we go to the doctor, we're going to use our own money, so that's consumption. GM plant is a business, so that's investment. Space shuttle, government. Tipper Gore was the wife of Al Gore. They were previously in the White House as a vice president, but they are no longer, so we're talking about consumption. A trip to Paris on Air France. Air France is a foreign corporation, so we're talking about net exports. If we go to Dallas, Texas, that's going to be our personal trip. Delta is going to be an American Airlines, so therefore consumption. The president flies only on U.S. Air Force One, so therefore government pays for all of his flights. Government pays for all of his flights. So in looking at the next problem, let's go above. I'm going to have C above. See above. So I'm going to go to the previous page, and as you can see, when we look at this, we have income, 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 profits. So we know we have to use the income formula. So we're using the income formula for gross domestic product. For gross domestic product, we will use the income formula. So I'm going to come back up to the previous page that's blank so that we can write this out. We're going to take wages plus interest plus rents plus profits. And remember, we have a sole proprietorship, partnership, or corporation products. Add back capital consumption allowance, add back indirect business taxes, and subtract off net factor income from abroad. That will give us gross domestic product. So in looking at this, we have the following. We have wages given to us at $650. We have interest given to us at $35. Rents given to us at $25. We have sole proprietorships and corporate profits, $70 and $80. We have capital consumption allowance at $10. We have indirect business taxes at $40. And we have net factor income from abroad at $30. So our gross domestic product calculates to be $880. $880. So we have $880 for our gross domestic product. Now we're going to take gross domestic product, add back the net factor income from abroad, and that will give us gross national product. So 880, add back the 30 from net factor income from abroad, and we'll end up with 910 as gross national product. To find our net national product, we're going to take our gross national product and back out capital consumption allowance, and that will give us net national product. So gross national product was 910, capital consumption allowance is 10, so our net national product is 900. To find our national income, we're going to take our net national product and back out the indirect business taxes, and that will give us national income. So net national product is 900, back out the $40 or indirect business taxes, and we will have $860 of national income. Our next one is known as the personal income. So we're going to take national income, we're going to add back income received, not earned, such as a transfer payment, and subtract out income earned, not received. And that will give us personal income. So we'll start with 860. Income received but not earned are transfer payments. Add those back. Back out income earned but not received, Social Security taxes that were withheld, and retained earnings. And retained earnings. Retained earnings are earnings kept by the corporation and not given to the owners of the corporation. So we have 25 to subtract out, 5 to add back, so that gives us $840 of personal income. The last item is our personal income minus personal taxes to give us disposable personal income. So for our personal income, we calculated at $840. Now we have both personal taxes and we have real estate taxes that we pay on our homes. So real estate taxes are personal taxes Just like federal income tax is a personal tax, just like state of Oklahoma tax is a personal tax. So once we back out $155 of personal taxes, we will end up with $685 of income that's spent in the economy. We started at $880 and we have spendable income of $685. So we went through the income formula. This is what we gross. This is what we spend. We gross $880. We can spend $685 of that income. Okay, let's go back to that page. And let's come down to the bottom for problem number 3. Now it says, give an example of when this would be excluded from gross domestic product and when it would be included from gross domestic product. So the first item we look at is housework. Housework is excluded if you do it yourself. Cannot include that because we don't know the value to include. You would include that if you hire this done. So if you hire somebody to clean your house, that's the fair market value. That is included in gross domestic product. Sale of an automobile. Excluded are used property. So therefore, all used automobiles are not included in gross domestic product. Only the first time that automobile was made is it included in gross domestic product. If it's sold more than that one time, none of those values of the automobile are included because it's still the same product. When would we include it? First time manufactured. The first time it's manufactured, the fair market value of that automobile, how much does it cost for the full cost of the automobile, is included in gross domestic product. C, government disbursements. All transfer payments are excluded from gross domestic product. If you're receiving a Pell Grant, that is a transfer payment, and it is excluded in gross domestic product. It's added back to arrive at personal income. If you receive a farm subsidy program, then that money that you receive is a transfer payment. If you receive unemployment compensation, that is a transfer payment. If you receive women, infant, children expenditures, that is a transfer payment. If you receive legal aid, if you receive health care, these are all transfer payments and they are not included in the gross domestic product. They're added back to arrive at personal income. So the question is, okay, if all transfer payments are not included, what are we going to include for a government disbursement? Well, I live here in Altus and we have a military, Altus Air Force Base, here in my town. So therefore, all expenditures at Altus Air Force Base, maybe they're buying airplanes, maybe they're buying computers, maybe they're buying equipment, maybe they're buying autos. All expenditures that the government buys in order to run the government are known as government disbursements. Okay, next item says you're betting on a horse race. Most often, you'll never see it if it is an illegal transaction or if you're betting with your friend. So if you were betting with your friend on the Kentucky Derby, chances are you're not including that in your federal income tax return. Whether you made money or whether you lost money, most of the time illegal betting or betting between friends are never included as income or losses on the federal income tax return. They're excluded from gross domestic product. When should we include it? When it is a legal betting establishment. So if you come to Oklahoma and you go to Remington Park horse racing and you win money, trust me, the IRS is right there, and that money you will probably have to pay a portion of your winnings to the IRS. They will take it out immediately, and you'll receive a 1099 in the mail because this is a legal betting establishment, and you will have to include that income in your 1040 tax return. So yes, we can find that, and we will locate that in the gross domestic product. So these are just some circumstances. Please go back to my notes, see my notes, and I've given you several examples in my notes on the web page that deal with when are items included or excluded from gross domestic product and why. We must remember that gross domestic product is a leading indicator of our standard of well-being, but it is not an absolute positive indicator because we can't find a lot of some of these areas. So it's the best one we have, but nothing is perfect as far as an indicator. Okay, let's go on to the next page. Now, that was the first part of the chapter. The second part of the chapter is going to initiate you into inflation. So inflation is a sustained rise in prices. So in working with inflation, we have to figure what's called the price index. The price index is simply the current year price divided by the base year price, which is given. Base year is always given. And then let's multiply through by 100 to get rid of the fraction. So in this case, year 3 is the base year. It tells us use the prices of year 3 as your base year. So the price is $200 for year 3. So we're going to divide each year by 200, divide each year by 200, divide each year by 200, divide each year by the 200 base year price to come up with our price index. So once we do that, year 1, the price index is 85. Year 2, the price index is 90. Year 3 is the base year. Year 4, 100. Year 5, 112. And year 6, 125. Now you're saying, okay, well, what is it that you've just done? Year 1 prices are 20% lower than base year prices because the base year price index is 100. Year 1, and I apologize, that's 15 and not 20. 85 from 100 is 15% lower than the base year. 85 to 100 is 15% lower in year 1 than in the base year. Okay, if we look at year 6 prices are 25% higher than the base year prices because the price index is 125, base year is 100, so it tells us that the prices are 25% higher in year 6 than they were in the base year. All right, let's go on down, and we're going to calculate some more of these. In the second item, it says calculate the nominal GDP, calculate the GDP deflator. That's the same thing as a price index. And calculate the real GDP. If we're going to measure apples and apples, we're going to have to get to the real GDP. Most of you all were born after the 1960s, so therefore the United States has experienced inflation since the middle 60s, or in essence you've lived your life with inflation. But once again, we cannot use inflated prices when we're valuing the economy. we have to take the inflation out so that we can measure real GDP to real GDP. And that's what we're going to do in this problem. First item we're going to do is find the nominal. That's known as the current GDP, uses current year prices. So we're going to take 100 times $4, 120 times 440, 110 times 5, 110 times 520, 135 times 520, and 140 times 560. In dealing with that, once we do that, we're going to have 400, 480, 550, 572, 702, and 784. Calculating your current or nominal GDP. Now it tells us to use year 1 as the base year. So the price index of the base year is always 100. So base year price index is always 100. So we're going to compare everything to year 1. To deflate the current to the real, we're going to take the nominal GDP, we're going to divide that by the price index, which is also called the GDP deflator, multiply through by 100, and that will give us the real GDP. That will give us the gross national product using real numbers. Okay, we need to find the price index, also called the GDP deflator. We need to find that. So what we're doing is taking current year price, divide it by base year price, and multiply through by 100 because we need to get rid of that fraction. So year 2, we have current year price of $4.40. Base year is always $4. Multiply through by 100, and that will give us a price index of 110. That will give us a price index of 110. Year 3. Year 3, we have $5 over $4 times 100, and that will give us a price index of 125. Year 4 and year 5. Both years the price is $5.20. Base year price is $4. Multiply through by 100 to get rid of the fraction. So both years 4 and 5, we have a price index of 130. Last year, we have a price of $5.60. Base year price is $4. So that tells us that we have a price index of 140. So I'm going to put those numbers right back up here. We have 110, 125, 130, 130, and 140. Okay, let's do exactly what the formula tells us. We're going to divide the nominal by the GDP deflator. We're going to multiply through by 100. And we're going to come up with our real GDP. Absent of inflation is the real GDP. So once we calculate it through, we'll come up with 400 for year 1. We will come up with 436 year 2, 440 for year 3, 440 for year 4, year 5, 540, and year 6, 560. So as we can see, we are growing 400 to 436. So real GDP is going to give us growth in production. So we've grown by $36, or if this is in millions, $36 million. From year 2 to year 3, we've grown by 4. We stayed the same in year 4. Year 3, year 4 is the same. We grew by 100 from year 4 to year 5, and year 5 to year 6 we grew by 80. So in order to figure out have we experienced economical growth absent of inflation, we have to look and compare real GDP. Look and compare our real GDP. If we went back over to nominal GDP, look at year 6. Year 6, our nominal GDP is 784. But in real numbers, as according to year 1's base prices, our gross domestic product is only 560. So we know that that difference is the growth in products, and a lot of it is the difference between paying $4 for the product in year 1 and paying $5.60 for the product in year 6. Same product, same quantity, same everything. It's just that the price of the product has increased. So this is an introduction into our next chapter that deals with unemployment and inflation, but it will help you to see how important it is that in the field of economics that we have to understand that inflation is like opening a window and throwing money out the window, because it eats into the purchasing power of the dollar. We can't see it. We're earning it, but we're not being able to see it in products. We earn it, but we can't see it in products. So hopefully that will help you with chapter 5. I will continue, and when we get into the next chapter, we're going to skip chapter 6 and go into chapter 7 with unemployment and inflation. We'll be going back into this subject matter as well as picking up unemployment. I'll see you then. Bye-bye.